Hello friends, welcome back to your own channel. Well, first friends, from yesterday we have started the new series of future and options, and many of the subscribers were saying that sir, please post the videos in English as well, because there are many subscribers who are wanting to read and who want to learn, listen in English. So for them I have made this video. I have also posted the similar video in Hindi as well earlier. In case you know English, then you must watch this video, because there may be some comments which I might have missed out in my Hindi video and I may be including in this video. So this video is very important for you all as well. And if you have not subscribed to the channel till now, then friends, you are really missing a lot of action, because there are so many contents with so many things which I am uploading free of cost and without any membership. In case if you want to learn more, you can of course join as a member and learn more. So without wasting the time, let's begin. First of all, I'll just orient you to the broader horizon so as to give you a holistic picture of the market. How does financial markets work? Financial markets work in three major categories, and the one is the equity markets, the commodity markets, and the forex market. What is equity markets? Which we do daily, buying and selling of shares. That comes under the category of financial market. Now second category is the commodity. What is commodity? Buying of sugar, buying of steel, buying of zinc, and so on. There are so many commodities including gold, silver. They all are part of commodity, and they are being traded on daily basis. You would have heard about MCX, commodity exchange. So this is the platform on which you trade commodities. And of course there is foreign exchange, in which you trade foreign exchange vis-a-vis the Indian currency, and that is called forex trading. So these are the three major financial markets in which the financial markets operate. Now, I am not going to talk about the FNO concept in commodity and forex. However, this principle is equally applicable for commodity and forex both. Now, we'll just broadly tell about the commodity and forex. However, we'll discuss more in detail about the equity. How does equity work? Equity works in two segments. One is the cash segment and one is the derivative segment. Now, first of all, what is cash segment? The stocks which you purchase on daily basis, you buy and you sell. Maybe you hold the stock for a day, or you may be holding a stock for a month, or maybe a year, or maybe a decade. That comes under the cash segment. However, if you are not wanting to give complete money of the amount traded, that comes under the category of derivative. But there are some difference what derivatives comprising of. So derivative comprises of two major contracts. One is called futures contract and one is called the options. So future and options comes to the category of derivatives trading. So we'll talk about what is futures. What is future? For example, if we talk about two companies, one is the oil company and one is the aircraft company. So if aircraft company wants to make sure that if it gets the fuel, the oil, at a fixed price after 1 month, because there's so much of volatility in the market, especially because of the Middle East issues, and recently the crude has fallen so badly. So in that case, it may so happen that the crude price may go up, and so can the fuel cost. So what does aircraft company wants? It wants that after a month there should be a fixed price at which it should get the fuel or the oil. I'll just take an example of oil. It wants that in the month end of March it may get the fuel at a fixed price, and it will buy the future of that particular price. Now what will oil company do? Oil company will sell the future of oil at a particular price, so that it doesn't get loses its revenue. So in that case, both the companies come into contract. So there is not a written contract. It's all at the database, at the backdrop things are happening. So they don't enter into a written contract in which you sign a contract and you are afraid what is going to happen. Everything is falling in the backdrop. So by selling futures of a particular price, the oil company has assured sale of the oil at a particular price, whereas the buying the future at a particular price, aircraft company has assured getting the fuel at a particular price. So that price is called futures, in which it has agreed to sell and it has agreed to buy. So this is the concept of future trading. Now we will understand what is future. Future are the derivatives. What are derivatives? For example, now I'll take the example of securities. Securities means stocks. For example, if you are trading a State Bank of India stock, then the SBI stock futures will be a bit different from its actual stock price. There is a reason why they are a bit different, because of the various expenses which are carried out by exchanges and of course the brokerages. That's the reason why there is a minor difference in the prices. However, the future prices are derived from the actual cash market. So whatever be the price of that stock, the future price will be derived from it and will be more or less similar to it. And as I've already told you, it is a hedging tool. It is not a gambling tool. It is a hedging tool for big investors, because you know oil companies trade a lot of oil, and at the same time the aircraft companies consume a lot of oil. So they want no volatility and they want a fixed price and want to get an assured price in future. So they buy and sell so that they are not suffering any volatility of the market, and they sail smoothly. So this is the example of a commodity which I have told. Now if I specifically come to the stocks, if you are trading any stock, any particular commodity or a stock or any other exchange, any other currency, then they are actually normal share. For example, if you are trading about SBI futures, then you must take SBI futures as normal shares. They are not any different category of investment. They are as simple and as natural as normal shares. However, the only difference is that they are traded in lots. In stock, in liquid cash, you can buy one stock, you can buy 10 stocks, you can buy 5 stocks, you can buy 100 and thousands. However, in futures there are lots, and each lot is decided by the exchange how many shares will be comprising in one lot, and there is a particular date of expiry in each and every futures. So on that expiry day, the future contract will get expired. So as I've already told you that futures are a hedging tool for big investors. So in case if they get into a contract with full money, there is no point of getting into futures. So there is a small money which they have to deposit, which is called security money, That is a kind of very small 5 to 10% of the money which they have to deposit to the broker, to the exchange, so as to make sure that they get into that specific contract for a specific period. So you don't have to pay the full money of the complete contract. So now what does the future mean? I'll just explain you in the definition terms. Futures, also called future contracts, allow traders to lock in a price of underlying asset or commodity. The contracts have expiration dates and set prices that are known upfront. So that security which you have to deposit is known as upfront money. The futures are identified by their expiration month. For example, the December gold future contract expires in December. For example, if you buy a stock, say Reliance, then if you are buying in this month of February or March, then that will be called March future. If you buy in the month of February, that will be called February futures. Or if you buy in that any particular month, they are named on the basis of the month in which you have bought them. Now you've understood futures, how do they operate broadly. Now your question will be running in your mind, how are the lots defined? So lots are defined, and lot sizes are defined in such a manner that the lot size remains, the price of that lot size remains almost the same, which in India is approximately of 10 lakhs. If the stock price is less, if the stock price is cheaper, then the quantity gets increased, and if rate of that particular stock is more, the quantity is made less. Overall, it is made sure that the future contracts remain in the price range of 5 to 10 lakhs. This is the broad thinking of how the future contracts of equities are made. Now, what I said in this slide, I shall be explaining you in this example. For example, you can see that the futures of ACC are having lot size of 400 stocks. What does this mean? That ACC, you know, the price of ACC is around 1500 rupees. It's generally around 1500 rupees. So in case if you are buying lot size of 400 stocks, the cost of this futures will be rupees 6 lakh. Okay, you don't have to pay full. I have told you, na. That I'm going to explain you subsequently. However, if you talk about Adani Ports, the cost of one Adani Port share is approximately 300 rupees. So the cost of one lot will be 7.5 lakh. But at the same time, you don't have to pay full amount. You just have to pay around 10% of the money, which is 75,000. So once you get into a future contract, you just have to pay the security money. Now you've understood the lot size also. Now a question which will be running in your mind will be that I had told about the expiry. What does expiry mean? Expiry means future contracts have expiration date, the date on which the contract gets expired. However, in case if you are wanting to roll over your future contracts for subsequent months, you can roll over for 3 months. They are rolled over to a different month to avoid the cost and obligations associated with the settlement of contracts. The future contracts are most often settled by physical settlement or cash settlement. So generally people settle it by the end of month, or they can roll it over up to 3 months. Now the question which will be running in your mind that if you buy futures, do you have to wait till month end, or can you sell it on day-to-day basis? So the question which is coming in your mind is very, very apt and very, very pertinent. So can I sell before expiry? Of course you can sell the stock on the very, very day which you have bought. It is not necessary to hold on to a future contract till expiry. In practice, most traders exit their contract before the expiry date. In fact, I am telling you, most of the traders exit their trade on intraday basis. They don't even trade for a day or two, or maybe a month. They even trade for a day. They buy in morning and exit by the evening. Now, one very important thing which I want to share over here in this slide is that in cash segment, if you sell a stock, you have to cover that selling position in intraday by the end of day. So you can't you can't sell that stock and buy it tomorrow, because you have to cover that position that very day. However, in futures, you can sell that stock today and you can cover it maybe tomorrow or day after, or maybe after on the expiration date. So in this you get the facility of short selling, and if you have not seen that video of short selling, then you are really missing something. Please go and have a look at the short selling video as well. Now the question will be running in your mind that in case if I hold on to the stock or to the futures for a day of expiry, so what does expiry mean? What happens on the expiry day? So on expiry day, nothing much happens. It's not that something big is happening and you are getting hassled. On expiry day, simply the contract gets expired. So in case if you are having profit, that means if you bought at rupees, say suppose SBI, if you bought SBI futures at rupees 250, and by the end of the month the price of the future at the end of month is rupees 270, then every stock you are having profit of rupees 20. And if there are stocks size of 1000 shares, a lot of 1000 shares, then you get the profit of 20 into 1000, that makes it 20,000 profit. So this is how the calculation of profit is done on the expiry day. And in the same time, in case if you are having loss, then there will be the loss of 20,000 which you have to settle on the expiry day. So the settling mean you don't have to go anywhere, or you don't have to approach somebody. It's just M2M, that is mark to market, which is being shown in your profit and loss account. That will be automatically settled. You just don't have to do anything. It will be settled automatically. I'll just explain the expiry of the future contract in a better example. For example, if you bought the futures in January, so they are called January futures. Suppose if you bought SBI in January, SBI futures in January, so they are called SBI January futures. So you can the first expiry of January futures will be on the last Thursday of January, and the second expiry you can, in case if you want to roll it over, you can roll it over to the next month, and the second expiry will be on the last Thursday of Feb month, and the third expiry will be on the last Thursday of March. So basically the point is that you can roll over your positions for 3 months, and on the last Thursday of the month is the expiry date. Now the question which will be running in your mind now will be that how much money do we have to pay in case if you want to buy. So I'll just explain you with a very good example. Like if I've told you, in future contracts, exchanges initially they set an initial margin requirement of as low as 5 to 10%. So in general, the security margins are 10% of the total contract value. That means if you are having the lot size of rupees worth rupees 7 lakhs, then the security margin will be rupees 70,000. So this will be 10% of the total value of the contract. So in case if you are having suppose if you bought crude oil futures and the value of that is $1 lakh or something of that sort, then of course you just have to pay 10% of the amount, which means $10K is the amount which you have to pay for entering into that futures contract. Now, if you talk about the Indian stock market, one lot of SBI, I'm just giving you one example of SBI, that if it is trading at the rate of 250 rupees, and if you buy the lot of 1000 shares and the margin is 10% margin, you have to deposit the margin at the rate of 10%, then how much security margin you have to pay? Then you have to pay absolutely 1000 to 250, which makes it 2.5 lakhs, and the margin which you have to give is 10% of 2.5 lakhs, which is 25,000. So this is how the margin is calculated for futures contract. Now you've understood everything. Now you are just set to go. Now the question will be running in your mind that if I buy tomorrow, what is going to happen? What happens when you buy? So when you buy, then there will be two things which will be happening. Either the stock price starts to go up or simply it starts to go down. But if you are thorough in your technical analysis, if the price is set to go down, what will you do? You will sell it first, so that once you sell it first, then you buy it here, then this margin is called the profit. And if you are good in technical analysis, the video of the same have been posted by me already in my English lecture videos. And if you're good in technical analysis, then you'll buy at the price when the stock is ready and ready to bounce back, and you sell at the price when you get the profit. So this profit and loss is shown in your trading terminal in mark to market, which is daily profit and loss, which is showing in your daily profit and loss account. So if we understand the definition of mark to market in futures trading, it is the process of valuing asset covered in a futures contract at the end of each trading day, and then profit and loss is settled between long and short. So basically what it means is, by the end of the day, you will get the complete profit or loss in your own account by the end of the day. That is called mark to market. So as I told, there can be only two possibilities once you buy. The price starts to go up. If the price starts to go up, then the profit comes, and the profit is credited daily to your account. In case if the prices decrease and if you have bought and the prices start to decrease, then of course this will be considered as a loss, and the amount will be deducted from the account which you are holding. So this is the complete definition of the futures, how they operate. However, there are much more powerful videos how to operate in F&O, and what are the various terms, what are the various ways to operate, how to benefit with the F&O. Because till the time you're not having complete knowledge of F&O, I will not request you all to venture into this segment, because this is a bit technical segment. It's not as simply as cash delivery. However, in case if you have not seen that video of short sell, I will request you all to go and see this video of how to short sell. It's a very important video. You can't afford to miss this. Thank you so much, friends, for watching, and many more powerful videos to come. Not subscribed till now, then you must go and subscribe to it for getting regular updates. Thank you so much, friends, for watching. Bye bye for now.